Hey everybody, Allison here. I am the Director of Risk Tolerance as well as an option specialist here at Simpler Trading. And today I'm here to give you the next update on my $500 challenge account. So here's my main account. Currently, right now, the trades that I am in, I have a trade on CVX, which unfortunately is going to expire today worthless. The market saw quite a tumble yesterday as we went back down to test support levels. I'll pull up the main chart here in a second to talk about that. And unfortunately, I was in a very short dated trade for this week. It was either going to work or not work out. In this case, it didn't end up working out. So on this strategy that I implemented, I usually have a win rate of a little over 80% versus my losses. So unfortunately, this is going to be one of those losses for the account. But this is why it's so important to manage your risk and be mindful of risk. This is about an $87 risk. It's an 80-cent net debit on a one contract trade. So $87 is what I'll probably end up losing on it today. But I'm okay with that because I've been able to maintain quite a nice profit. I've certainly maintained the capital in my account. And so with this kind of being the first big loss in the account, other than UPS, which we'll talk about here in a second, I'm okay taking it because I know it's already covered by profits and I'm still net ahead in the account and on my challenge as of right now. So it is what it is. With trading, we have to be okay accepting losses, and this is what I'm going to have to accept in here. EA, now this, we talked about last time as being my problem child. This has worked out beautifully this week. I'm almost kicking myself for not having cost averaged the trade. I would have ended up with a much better profit. But this was a great trade and a great kind of education and teaching to myself once again that remaining patient and following the signals that we see on the chart is always a good idea. So let me go ahead and pull up EA here on the main chart, and I'll bring that over to talk about right now. So EA, when we talked about this last week, I mean, it saw a drop off, right? This just started to sell off. Now, what were the things telling me to still maintain bullish on this trade, right? What was also maybe the sign saying that I should have looked at maybe adding a bit more capital into it to cost average it, which I didn't. Still worked out fine. But some of the signals, some of the clues that the indicators that the charts were telling me to stay in this trade is one, the trend itself is still overall bullish, right? On my charts, these orange, yellow, gold, whatever color you want to call them, dashed lines to solid lines are my simple moving averages. The shorter dated simple moving average at the 10 period simple. The next one is the 30. On below both of those is the 100. When they're in a stacked up formation like that, where it's the smallest one up top to the longest at the bottom, that is a stacked up bullish formation. So even with the pullback that we saw last week, we never saw that formation break. So that was my first clue to still stay long in EA. One of my other clues was this bullish divergent bar. I'll actually be teaching a class on this later in the month about this signal. But this here was a sign that I would probably follow through with some higher highs within the next few days, and in turn be able to return ideally back to my strike, which I did, or above it, right? So that was a bullish sign there. The third thing that really told me to stay in this trade was the fact that the Bollinger Bands, which are these blue lines here, did not start to flare open up or down, right? They maintained being flat and parallel with each other. And the Bollinger Bands, for those of you who don't know what that indicator is, it's a free indicator on most charting platforms, much like the simple moving averages. And the idea is that the price itself trades within the second deviation Bollinger Band, which is this inside blue line here for me on my charts. And you can see when we zoom out, the majority of the time, the price trades within that level, right? When it starts to move outside of that level, either to the upside or downside, oftentimes the Bollinger Bands need to stretch open, right? They need to flare open in order to accommodate that potential move. So sometimes they'll start to flare open prior to the move. Sometimes the price will kind of cause them to flare open as well if it's pressing up into that level. But notice here the price actually went down below the second deviation lower Bollinger Band, but that Bollinger Band did not move, right? It did not flare open to the downside. It remained completely flat. And when it does that, that's a good sign that it's not anticipating that move lower, right? The price isn't even trying to force it to flare open. It's saying, no, I'm staying flat right here. And because of that, that was a good sign that we probably weren't going to follow through on a lower low, and instead could end up seeing a bounce back up to the top of the range, or like I said, potentially for a move higher. Of course, we still even today have this daily squeeze printing, which means that we should potentially see a greater than expected daily move. So that's always good to see. Currently, right now, we still actually have a very nice bullish signal on the compound breakout tool, which is valid. So that means the squeeze has a good probability of firing to the upside. Momentum is picking back up currently. The price itself is holding the 10-period simple still. So even with the sell-off yesterday in the market, notice how EA just went right down between yesterday and today to the 10-period simple. It held that level of support, and it's bouncing back up. So EA still, to me, has a lot of bullish sentiment, even with the weight of what we're seeing in the market, at least into the end of this week. And so because of that, what I did in my account on this trade, instead of just closing it out for a profit, I actually decided to profit recycle the trade, guaranteeing myself a minimum profit potential of 54 cents. So worst case scenario on this trade, I'm walking away with 54 cents of profit per contract, which is a $55 capital profit for my account, and I can move on to a new trade. The benefit here is if EA does stay out of the money of my 125, 126 strike, or does actually move lower, right? Maybe it breaks down with the market next week, if that's what we're going to see. Then worst case scenario, I still have a profit. Best case scenario is if the price exceeds above 126. If the price moves back above 126, which it was there just the other day, right? The high yesterday was 127.54. So if it can just get back up to that level, this spread will be in the money. And my max profit potential on this trade would be $1.54 because it's the 54 profit that I've already guaranteed myself plus the dollar width of the spread being added to that. So worst case scenario, I'm walking away with a profit on this trade. Best case scenario, I'm still walking away with a profit. Most importantly, I protected all that capital that was at risk last week, right? Last week we had about a $1.60 drawdown, which was a $160 drawdown on the trade. I was able to get out of that drawdown, reverse it back into a guaranteed profit, and now I have this kind of as a free trade out in my account if we do end up seeing that squeeze fire high up into next week. So I love this trade currently. There's actually one more step I could take here to guarantee myself a bit more of a profit, which I might look to do next week. But right now I'm okay holding it as a long debit vertical spread, and I'm okay where it stands at currently. So very nice profit, protecting the capital moving into my account. Great spot there. The next trade I'm in is INTC. Now this one did see a drawdown. This one I might consider cost averaging. The mark right now on it is 26 cents, so it's relatively inexpensive. I definitely have enough capital in my account to be able to cover and cost average this trade if I need to. When we take a look at the chart for INTC, I opened this trade based off the weekly chart with this bullish divergent bar. That means I need to give it 3 bars for it to work out because it's the weekly chart. That means I need to give it 3 weeks to work out. So this week, we did not follow through with a higher high. Instead, we sold off and are currently testing, trying to hold support. If we can maintain holding support into the next 2 weeks and get a bounce back up, there's a good probability this could go back in the money. And in turn, my spread could allow me to walk away at least at break even or some sort of profit. Certainly if I cost average the trade, that might benefit me a bit more on it as well. Now I do need to still be mindful of what the daily chart's telling me. So let's take a look at that. Right now the daily chart has sold off. It's right at the ATR trailing stop, trying to hold that as support. Bollinger Bands are still relatively flat here at this time, so they're not strongly flaring open. That's a good sign for us, kind of like it was on EA. If going into the start next week, they do start to flare open to the downside and break apart, then I might need to look at managing my trade a little bit more closely. Maybe look at flipping it from a bullish trade to a bearish trade, right? But currently right now, the signal that I've taken off the weekly chart still has 2 weeks of time to work out. This is why we gave ourselves on the trade time for the trade to work out, right? This is a June 26 expiration, so I still have next week and the following week for this to work out, right? So we've built time on the trade. And then, of course, if this does hold and we start to bounce back up, especially if I look to cost average it today, there's still a good probability I could walk away with a profit, much like I did on EA. So this is another test of my patience right now. We'll see whether or not my patience can hold out, but the trend itself is still bullish. I like that support's holding. I do want to be mindful of this market sell-off, right? But otherwise, overall, this is looking good to me to try and hold at least through the weekend. And then with this market sell-off yesterday, I did put on a hedge trade in SPX. I realized I didn't have any hedges in this account. So where my main account was kind of protected because I had a hedge on in that account to help protect my bullish trades. And this account, right, that's sell-off kind of hurt me yesterday. So this was a bit more emotional of me. I can admit that right now. I only gave this a day for it to work out in case the market just continued to tumble to the downside this morning. Instead, it bounced up and it's trying to still maintain 3,000, which is a good thing to see overall. But I jumped into this trade here. Oops. There we go. I jumped into this SPX trade, really kind of a lotto trade at $1.60, probably a bit more capital than I should have put into this trade. In hindsight, I should have left this trade more on SPY as a lotto hedge trade to the downside. I usually use SPY for my hedge trades, to be quite honest. But in SPX, like I said, I think I got a little bit emotional into the close. I was trying to protect my account in case we did tumble to the downside, so I put that on. And unfortunately right now, right, there's not much value to it. I might consider closing it out. I'm watching the intraday charts right now, actually on my other display here. And they're still a little weak, so I'm still holding on to it currently. But the trade I do like that I put on today was based off an intraday move, right? This is something I'll actually be teaching in my class coming up as well. And what I did was I started with the 3,000 put. I got in at $1.30. Now I meant to lock in a bit more of a profit than this. For some reason I thought I got filled at $1.20 for a 50-cent guaranteed profit. Instead, it's a 40-cent guaranteed profit, a $40 profit potential, basically minimum. But what I did is I basically turned my long debit put vertical spread into a butterfly, covered it for $1.70 credit, as we can see here. And in turn, worst case scenario on this butterfly trade, which also expires today, I could end up with the $40 profit minimum. And if we do end up pinning at 3,000, which certainly is probable, right? That's kind of the level that we closed at yesterday. It's right around daily support, which we'll talk about here in a second. So if we do go back down to that level and start to pin there, I actually have a max profit potential of $5.40. 40 cents being that guaranteed profit locked in, much like we talked about on EA. And because this is a 5-point butterfly, that gives me an extra $5 profit potential. So capital-wise, I actually have a max profit potential of $540. Now, what this basically did is, worst case scenario, it helped reduce my loss today on the 29.80, 29.75 kind of emotional trade I put on yesterday. So it helps reduce that loss overall, which is great. Best case scenario, it ends up covering that loss and I could still walk away with an overall profit on SPX today and add that into my account. The benefit of doing this on SPX is technically this action where I've guaranteed myself a profit for today did not cost me any day trades at all, right? I haven't technically closed out of anything. I still hold everything open currently. Because SPX is a cash settled index, meaning I have no risk of assignment on shares, this will end up cash settling at expiration and still allow me that potential overall profit. So very happy to see that. It reduced my capital risk. I might look to put on another one of these today if I get the signal. In this account, I've actually taken this trade several times in my main account. I'll just move this over here. You can see in my main account, here's today's expiration. And between yesterday and today, I have 4 guaranteed profits locked in and basically 4 lotto trades set up. So no matter where we close, I have some nice psychological levels here to where I could walk away with a profit. So very happy about that. So my main account's looking pretty good. I only did it once in my $500 challenge account today. So happy I was able to guarantee that profit. Like I said, with the market still looking a bit weak, there's a good probability we could go back down towards 3,000 to test this and to close. And if we do close around that level, hey, it could completely cover my risk and still allow me a decent profit, maybe even cover the risk for CVX today and allow for a profit there. And SPY, this is a trade I technically already closed out of today, but I might look to re-put on with different strikes. But the reason why I put this on yesterday and took the small profit today, it's the June next week expiration, June monthly 310, 312 call. And part of the reason I put this on, like I said, I usually put these hedge trades on in SPY, but we'll pull up SPX. It's going to be a similar chart view. The reason why I did this is because we held that nice psychological level. And next week is triple witching. So because next week is triple witching, there's a good probability that this price could end up bouncing up into next week's expiration, right? This is kind of what we sometimes call here at Simpler Trading. I think other traders also use this term of a pit bull low, where it basically, the market moves lower for a day or two into the end of the weekly expiration. It forces anybody who was long, right? It kind of forces those emotional traders to be out of their longs and for them to close it out. Or if they had short-term expirations like I did on Chevron. Like I had on CVX for this week, right? It's going to force me to take that loss. And then all of a sudden it turns around next week into triple witching. You have a lot of hedge funds during this quarterly, monthly, and weekly expiration that all coincide with each other next week. It forces them to kind of close out of their trades, manage them, roll them out. And usually, not always, but usually you do see the market kind of trickle higher into those triple witching expirations. Certainly, it usually is a bit more of a volatile week. So we'll see if that ends up being the case this time around. May or may not happen. But that's why I did put on this bullish trade idea on SPY, because I knew there was a good probability that we could bounce up next week and in turn allow for a profit. Now, when we opened higher this morning, right, we opened about 50 points higher on SPX. So we opened up pretty nicely to the upside, went up to test resistance. I saw that resistance was holding on the intraday charts. I thought to myself, why not take the profit here? And then going into the close today, I can always reevaluate putting this trade back on, maybe putting on the same strikes for a similar or cheaper cost basis. Maybe instead actually going further, with different strikes or giving myself a little bit more time. But I took a small profit on this today, locked it in, protected capital once again. And so currently, right now, where I stand in my account, I have a 572 total profits. So very happy to see that. I'm still net ahead in my account with everything locked in. Commissions so far are $47.29. So, I'm still paying some for commissions, but not a lot. Capital in use right now, with all the trades I currently have out there, including CVX, which will expire today, I have a $432 of capital in play currently. So I have a bit out there, but my capital remaining, I have $690 of capital remaining. So I have quite a bit of capital that I can put back into this market and use for the next few weeks. So I will definitely be taking a look at a few different trade ideas. I'll actually be going live here on Twitch very soon to talk about this in further detail. For those of you who do have a Twitch account, you can watch that full live session on the video platform there. This is more of a just summary video. But I'm still happy very much with where I stand. Really quickly, the other trade that I did take a loss on this week, I do want to highlight that, was UPS. I got into this trade because originally going into the close the other day, it was making a bullish divergent bar. Right at the close, right? In the last few minutes of trading, this was the bar here, it ended up not printing the signal. So that already told me that when I saw that after market close, I was like, okay, Allison, look to close this out tomorrow, protect your capital. The signal technically wasn't valid. Yes, the trend still looked good. And then, of course, the next day was when the market sold off, and this just kind of tumbled. So technically this trade expired next week, but because of the tumble, because the signal that I originally looked to jump in on technically didn't print valid into the close, I decided to protect my capital, or remaining capital in the trade, I should say, and ended up taking a loss on UPS. I was in it for $1.15, took it off at 27 cents, and it ended up being an 88-cent loss for my account, $88. So, that was a kind of a loss for me. CVX will be a loss for me, but I gotta say, if those are my two losses and I can keep taking the profits I've been taking, they're easily going to be made up. They're technically have already been made up with the total profits I had locked in. If I were to cash settle everything as of right now, I would still be overall net ahead on the challenge, still have completely protected my capital, and be looking for new trades to implement, which is still my game plan for today. So very happy with where I stand currently. Like I said, the only action I might take today, other than opening some new trades, is cost averaging INTC as management. I might wait to do that until next week. But otherwise, everything else is looking pretty good. So that is the update for the second challenge, guys. Thanks so much for joining me today. As always, may the trade be with you. Don't let this pullback necessarily drive you out of your trades. Watch those daily support levels, watch those longer term support levels, and if they can continue holding, now might be a good time to actually look at buying back in. And if they do start to break, make sure you have a hedge or two out there in your account to protect your bullish trades overall. But I'll look forward to talking to you next time. Bye, guys.